The key question that has been in the air for quite some time is whether or not China is going to have some kind of a hard landing or whether or not it can avoid that. I'm going to address this really looking at a medium and even something close to a long-term context, a long-term framework about what's the best way forward for China to avoid a hard landing, and what are the kinds of policies, the new leadership, which is going to be announced next week, what are the kinds of policies that they should be looking at? Well, everybody remembers a couple of weeks ago the Chinese announced their quarterly GDP growth on a year-over-year basis, and we had the 7th consecutive quarterly decline. We're down to 7.4% compared to a peak of over 12% in the first quarter of last year, so that seems like the bears basically think this is going to continue and drag growth down quite a bit further. The optimists, on the other hand, take the same numbers and look at them on a quarter-over-quarter basis, and they say, actually, we're past the bottom. The worst was in the first quarter of this year, and the last 2 quarters have had a bit of an uptick. So if you're looking in this framework of a Q-over-Q basis, things don't look quite so bleak. But I would say, and what I'm going to talk about, I think there is still an ongoing debate as to whether or not the upturn on this quarter-over-quarter basis can be maintained going forward. Even when you look at this basis, it's fairly clear there's a significant slowdown in economic growth over the past couple of years. And I want to suggest it's really due to 2 factors, the external environment and the domestic investment environment. On the external side, China's export growth has slowed very, very dramatically. I think you can see here, this is quarterly data on a year-to-date basis. So reading the numbers, exports were growing at 30% in 2010, about 20% last year. But year-to-date, that is growth in exports in the first 3 quarters of this year compared to the same period of last year is only 10%. So it's a very, very low growth, and currently the external sector is actually subtracting about 0.5% of growth of GDP in the first 3 quarters of this year. Most of this, no surprise given what we just heard from Adam, most of this is a decline in exports to Europe. Europe is China's largest export market. Again, this is showing you data on a year-to-date basis. So year-to-date, it's not just that China's exports to Europe are growing more slowly than they used to. They're actually down between 5 and 10% in absolute terms. And based on Adam's analysis, I would agree there's very little prospect of a recovery in this anytime soon. So certainly the external side is one of the sources of slowdown in this economy, particularly over the last year. The other source of slowdown is that investment growth in China is slowing, moderating, primarily because investment in property has been softening. And you can see, again, the data here on a year-to-date basis. Property investment grew 30% in 2010. Over 30% actually, just under 30% in 2011. But on a year-to-date basis, in the first 3 quarters, property investment is only about a little over 10%. For residential property, it is 10%. So that's a very, very sharp slowdown. This has had obviously significantly adverse consequences for other sectors of the Chinese economy. Take steel, for example, 40%. China's producing about 700 million tons of steel a year. You've probably heard me say this before. They're producing more steel than the next largest 10 steel producers combined. 40% of that goes directly into property. And in 2009 and 10, when the property sector was booming, output was growing at about 15% per year, moderated to 10% last year, and in the first 3 quarters of this year, steel production has basically collapsed. It's growing at less than 2%. And the entire sector is now losing money at a very rapid rate. Now, property investment has become, over the last 5, 6, 7 years, the single most important driver of China's economic growth. So I think understanding the reasons for the slowdown in property investment is a key prerequisite for trying to understand what the Chinese economy is going to look like going forward. Is the pace of property investment likely to recover somewhat, maybe not go back to 30%, which is probably unsustainable, or is there some prospect it will continue to soften? Now, for quite some time, some of you have seen this diagram before, for quite some time I have believed that investment in property, particularly residential property, has been driven by financial repression, as reflected in this diagram, which shows you negative real deposit rates in China on average since 2004, also major restrictions on capital account convertibility, and an underdeveloped capital market. So what we've seen is more and more people are going into property as an investment, and that has driven property investment as a share of GDP into the stratosphere. China is not only way above countries like India and Taiwan that never had property bubbles, at least to my knowledge, but even well above Spain and the United States, which clearly did have property bubbles. So China's now at roughly 11% of GDP going into residential housing. I mentioned that I think it's mostly for investment. In other words, lots of people are buying houses not to live in, but as an investment. And this is the results of a very interesting survey released earlier this year in China, which shows the extent of ownership of multiple properties by people in urban and rural areas. You can see in urban areas about 15% of the households have 2 properties, maybe 4% have 3 or more properties, and the red line shows you that on average the ownership is 1.22. That is, 1 out of every 5 households has 2 properties. And one surprising thing from this survey was this phenomenon of investing in property is not restricted to urban areas. Even in the countryside, about 1 out of 7 households have a second property. This has been a major driver of property investment, and one of the reasons we've gotten up to 11% of GDP going into housing. My view for quite some time is that it's unlikely that this high rate of demand for investment property can be sustained indefinitely, and when it waned, it would drag down China's growth, and I think we're seeing some evidence that is the case. There was a recent survey by China Merchants Bank, one of the more progressive banks, of high net worth individuals, and you can see here over a 2-year period they're cutting their investment in residential property. They're going into other kinds of assets, alternative investment, wealth management properties, a little bit more into equities, but property is going down. So the appetite for property among these households is diminishing. A second factor I look at is household indebtedness, and you can see in this diagram that household debt relative to disposable income jumped very sharply in 2009 and 10 when the property boom was its most intense, but has grown a bit more moderately in 2011, and also, I'm not showing it on this diagram, but also in the first 3 quarters of this of this year. So maybe the appetite for multiple property ownership is moderating, and you see, particularly in the black line, that mortgages as a share of household disposable income actually began to come down in 2011. Indebtedness of households in China, by US or UK standards, of course, 50% is absolutely nothing, but this is a much higher level of indebtedness than you will find, I believe, than any other emerging market. You look at countries like the Philippines, Indonesia, you'd be looking at numbers like 9%, 15%, not 50%. So maybe the appetite for more debt on the part of households is beginning to moderate. This is another indicator that perhaps property cannot continue to be the driver of growth that it has been. Similarly, when I look at the composition of household wealth over a period of a little more than 10 years, you can see obviously people have bailed out of bank deposits because of the negative returns, and they've gone very heavily into property. Property now comprises 40% of household wealth, a little bit more than twice what it was in the late 1990s. So again, the question is this going to continue to increase? Are we going to have 60% or 70% or 80% of household wealth in the form of property? It seems unlikely to me that eventually households will want to hold more diversified, a more diversified asset composition. And finally, I'll just look at it from the point of view of the banks. Again, the red line is showing you loans to property in the form of mortgages and loans to property developers as a percentage of the bank loan book in China. It went up pretty dramatically in 2009 and 10, leveled off a bit in 2011, and is coming down a bit this year. Again, this suggests that banks are beginning to manage their risks more vigorously, that they're overexposed to property. You can see exposure to property was peaking out at 200% of bank capital, which means if there's any substantial adjustment in the property sector, banks would be pretty vulnerable. So I guess the final question I'll address is if property investment is going to moderate going forward, it's not going to stay up at 11% or continue to rise, but maybe begin to come down. What are the possible offsets in order to sustain growth at a reasonable level? Well, this is a diagram you've seen before. This is the long-term structural problem that China faces. Investment, particularly from the middle of the last decade on, rose pretty relentlessly, reaching a peak of about 48% in the past 2 years, that is in 2010 and 11. And the consumption share of GDP has had this long-term slide. So clearly the challenge is reversing this. If investment growth is going to slow down, if consumption growth does not pick up somewhat, we'll have a very substantial decline in China's GDP growth. I've talked about some of these policies in this room before. I'll go through these very quickly. On the exchange rate front, China has dramatically reduced its intervention in the foreign currency market. It was averaging about $450 billion a year in 2007 through 2010, dropped to $350 billion last year, and is only running at about $100 billion so far in the first 3 quarters of this year. So the first recommendation is that China should further reduce its intervention in the market and allow the RMB to be fully market determined. The second is to further financial sector reform, accelerate financial sector reform, particularly the liberalization of deposit rates, so there's not such a heavy tax from financial repression on the household sector. This would boost their income and contribute to the growth of consumption. They did take a small step in this direction earlier this year, but it was very small, and there hasn't yet been any follow-up. Eliminate subsidies for industrial energy consumption. China's consumption of energy is very, very different from ours. Fully 75% of all electricity is consumed in the manufacturing sector. The generating companies, the distribution companies are losing vast amounts of money. Basically, the manufacturing sector is being subsidized, just as it's being subsidized by the undervaluation of the exchange rate. This is tilting investment into manufacturing out of services, reducing the rate of growth of job creation, since obviously services is more labor intensive than manufacturing, reducing the rate of growth of wage income as a share of national income below the path that it otherwise might take, and thus leading to lower consumption. And finally, they have made some progress on building out the social safety net in order to reduce the precautionary demand for savings. Household savings rate in China is still in the stratosphere, and if the social safety net were built out along with interest rate liberalization, there's a very good chance it would come down. Well, I'll just conclude by looking at a couple of rebalancing scenarios. How do you get from this highly imbalanced economy with too much investment, not enough consumption, to the other way around? Quite frankly, these are just schematics designed to make a few points. The bearish scenario is based on the idea that you should cut the rate of investment, the growth of investment, fairly rapidly, and that this will have also an adverse effect on consumption. Hard to keep consumption growth up if your investment's falling quite rapidly. And you can see what happens here is that this leads to a relatively low GDP growth, something in the neighborhood of 5%. And ironically, even though you're having very slow growth of investment, you don't get very far on rebalancing. The investment share remains in the mid-40s, which is way too high. The bullish scenario involves a significant but somewhat slower path of a significant but somewhat slower rate of decline in investment, and the adoption of policies to encourage private consumption, so consumption growth stays a little bit stronger. And obviously in this scenario, you get much higher GDP growth and you get much more rebalancing. The investment share of GDP falls to 40%, a decline of almost 10 percentage points. Now, obviously, the intermediate case is kind of muddling through. Slower GDP growth in the bullish scenario, still significant rebalancing. The last column is showing it where housing investment as a share of GDP would be coming to in the three scenarios. Well, taking it back to the leadership transition, I think if the Xi Jinping, Li Keqiang leadership does push strongly on economic reform, the bullish outcome is within reach. We've already seen in the last 2 years that consumption, if you go back and look at this diagram very carefully, you can see that consumption growth actually ticked up a bit last year. And it is the case that over the past 2 years, consumption is growing above its 10-year average growth rate, and investment is growing below its 10-year growth rate. So we're already seeing that there is some rebalancing, and the relatively more rapid growth of consumption is helping to soften the slowdown in GDP. Remember, GDP growth last year was 9.3%, which was not bad given the slowdown in investment that occurred, not the decline in investment as a share of GDP, but the more moderate growth of investment. So I think the bullish case is within reach if they push ahead on some of these rebalancing policies. A lot of commentators are very pessimistic, and I have been pessimistic in the past as well. Lots of vested interests will not support structural changes that have advantaged them. I mean, the current system has advantaged the manufacturing sector at the expense of services, the inland, the coastal areas at the expense of inland, borrowers at the expense of savers, and so forth. But I think the likelihood is actually that vested interests will be forced to give way once there is a consensus that the alternative to undertaking more serious economic reform is a prolonged economic slowdown, and a slowdown that would probably take China's growth down into the 4 or 5% range. And even though different interests have very different perspectives, I think everybody in the top leadership in China in various sectors, regions, and so forth does share the view that the legitimacy of the party is based very heavily on sustained economic growth. And when the alternative is that that's going to fade away, some of the vested interests, I hope, will give way. We'll have more significant economic reform, and we'll get a China growing at 7 to 8% on a sustained basis going forward, with a much more balanced growth pattern and much less emphasis on heavy industry and investment as a result. Thank you.